a lot of the companies you just mentioned there don't pay much in dividends. They pay very little. And so if there's no income, the only thing you're betting on is their stock price going up. And if they can't keep growing everything, guess what happens to your account, right? It goes down. So that's a little bit hazardous when you're needing to get cash flow. Welcome to Wealth Creator Radio, where we help people overcome the uncertainty of having enough retirement income. I'm your host, Eric Heckman, a certified financial planner with over 30 years of experience. We want you to enjoy life and not have to wonder where your money will come from and how long it'll last. My mission is to show you how to develop a personalized income plan so you can retire more and have worry less wealth. Here at Wealth Creator Radio, we cut through the noise and get straight to what matters. We understand that the world of retirement planning can be filled with confusing products, ever-changing tax laws, and volatile markets. That's why we're here to help successful people like you navigate the uncertainty and create a blueprint for a thriving, work-optional life.
Hi there, welcome to our show. I'm Luann Fulmer. Joining me again today is Eric Heckman. He's a certified financial planner and president at Heckman Financial. And for over 30 years, Eric has helped retirees right here in the Silicon Valley area. He helps them turn retirement worries into lifetime confidence. And he wants that for you too. He can help you from wherever you are listening, okay? So Eric's mission is to help 1,001 people retire by 2031. So that's getting pretty close. Start your retirement blueprint with a complimentary visit by calling or texting the word visit to 800-454-1184. You can also get the digital toolbox. It has a lot of resources. It includes the book that Eric has written, plus other retirement resources that you can read about. Just text the word toolbox to 800-454-1184. And Eric, welcome to you.
Yeah, well, it's good to be going over, how to make sure people can worry a little bit less and enjoy their retirement. That's what we're here for.
Exactly. That's what our show is all about. So we know there are some words of wisdom that stand the test of time. And so we're going to do this again. And we're going to share some timeless advice for you to keep in mind for retirement. So Eric, you know how this goes. I'm going to give you a quote and I want you to talk about what it has to do with retirement planning. Okay?
Okay.
All right. So first one here, it's from Ben Franklin. A penny saved is a penny earned. We've all heard that one before. But what does that have to do with your retirement?
Well, since they're not printing the penny anymore, right?
Yes, right? Oh my gosh.
So maybe it's a little bit less appropriate as it once was, but
True.
A nickel saved is a nickel earned, I guess.
Yeah. What are we going to do with that quote from him?
Yeah, I know. But no, I mean, really he's talking about putting more money away, having that money saved. Once it's there, you can keep it and, and it's money that's going to be in the bank, right? And then you can keep compounding on it. And so a lot of stuff is based on time, right? So how long you have the money there, how much longer the money can sit there and keep compounding and get to be, more money for you and your family. So that's, you want to be putting that away and making sure you get building that pile of money up bigger and bigger every year.
Yeah, I love that. Compounding interest for sure. Okay, here's another one. And this, again, is from Ben Franklin. He was a pretty smart guy. Had a lot of quotes too, but he said this one. Wealth is not his that has it, but his that enjoys it. So what does that mean to you?
Yeah, well, I mean, one of the big kind of pet peeves I have is just getting people to go do stuff with their money, right? I mean, once you have that money, you go enjoy it, go do something with it. It's not points on the scoreboard. And lots of times people will just wait and wait and wait. And, and a lot of it's because they don't have a plan. They don't know that money's going to last. And even for my clients that have that plan and we've gone over that, lots of times still they have a hard time, going to spend the money. It's like, you said you always wanted to go this one trip. You want to go this one, bucket list destination. Well, I don't want to travel there. It takes too long. Well, you've got the money. Go buy business class tickets, just,
yes,
do it, right? Have fun, enjoy it. And, and that's the problem is lots of times people don't really want to enjoy their wealth. I mean, it's not that they really don't want to, but they're just too scared to go do it. And they've been saving and scrimping and getting by. And it's like, no. Go have some fun. Go do that stuff. Now, there's the other side of the coin there where people go a little too crazy and all that. So, you do want to do it, somewhere in moderate, level. But yeah, I mean, and that's the problem is if you go into retirement and it's kind of like driving down the road and your gas tank's on empty and the next, off ramp isn't for another 20 miles, you're just freaked out. All you're doing is looking at the gas gauge and trying to figure out, am I going to make it? Am I going to make it? And you probably can't even tell me what you were driving by at the time, right? When that was happening,
Right.
you're just
Yeah.
looking at that and that's it. And same thing with retirement. If you're always worried, always wondering, how are you going to know where you're going to go? So, that's why we built that blueprint to worry less wealth, where we go through that income plan. We, look at that, look at the taxes, look at the investments you have, and make sure that money's going to last. Make sure that money's going to be there for the rest of your life. And then once we know that, then you can, you don't have to worry about the gas tank, right? You're going to be good. It's going to be full enough and it's going to get you through and you're going to make it to your destination. So, again, it's easy if you have a plan, but if you don't have a plan, it's really scary.
Right.
And
Yeah.
so, yeah, if you want to set a time, all you have to do is text the word visit to 800-454-1184. Again, text the word visit, 800-454-1184, or book directly online at wealthcreatorradio.com.
We're so happy to have you along with us today. This is Wealth Creator Radio with Eric Heckman, and I'm Luann Fulmer. We're going through timeless advice. So I'm giving very famous quotes that we've all heard numerous times and asking Eric to explain what they could mean for retirement planning. So Yogi Berra, we all know him. He was one of the most famous baseball players of all time. He was very famous for his yogi-isms. And one of those was, well, speaking of nickels,
Yeah, right.
a nickel ain't worth a dime anymore. What's he talking about?
Yeah, well, that one's kind of like, what? When was it ever worth a dime? But
Yeah.
but that's the yogi stuff, right? So
Yeah.
no, I mean, really, yeah, you have to watch out for inflation, right? Things are going to get more expensive. We all feel older when we go, oh, I remember back when things were this much, right? But we all can say that now. And if you're going to retire and you're going to try to have this money last for your whole life, you can't retire on what you're making today. You got to make sure that money's going bigger and bigger and increasing with inflation, because nothing's going to get cheaper over time. Everything's going to get more expensive. So, just have that in your calculations and have that be part of that customized income plan. And if it is, yeah, you can do great. But if it's not, then yeah, things will be a little ugly, or a lot ugly later on,
Right.
because after about 20 years, everything about doubles in cost.
Yeah.
So.
Yeah, so that always worries me, Eric, for people who have pensions. They have this set amount of money coming in. And so at first in retirement, you're like, this is great. But then think about it. If you're 30, 40 years in retirement, yeah, you do have to plan for that money to continue growing in some way.
Yep. No, definitely. If you don't have that money getting bigger, it's, it's getting smaller, right? Because
Yeah.
things are getting more expensive. And, that's, I mean, it's great when you have a pension, but that's where, if you've got that, your own savings, that's where you're going to have to, start dipping in and supplementing it for the rest of your life.
Right. Which is why we're saying, Eric and his team are here to guide you with this. He's been doing this for 30 years. He and his team can help you create that plan. That blueprint to worry less wealth is what Eric and his team do for their retirees. Okay, here's another timeless advice. This one is from Mark Twain. And October, he says, is one of the most dangerous months to speculate stocks in. The others are July, January, September, April, November, May, March, June, December, August, and February.
Yep.
I think I just listed 12.
Yeah, that's all of them. Yep. So, no, I mean, yeah, anytime you're talking about the market, you don't want to be just jumping in and out. I mean, that's super hazardous. It can work, but can also fail very spectacularly. And I mean, I was just meeting with somebody who, it was kind of weird. He came to one of our events, but he'd actually done some work on my house.
Oh,
So
cool.
he's like, "Do you remember me? I did your drywall and stuff." I was like, "Oh yeah, yeah." No, now I know why the name seems familiar, right?
Uh-huh.
But yeah, but I mean, the hard part is sometimes, like he'd done some day trading and didn't go well, and he was telling me about that, and lots of times you see that where people are betting some stuff on stocks, and then all of a sudden, oops. It didn't turn out as good as you hoped. And so again, that's where you need a plan. That's where you need to have long-term success. And once you have a plan and you know where you're supposed to be putting the money, yeah, it works well. You don't have to worry about as much. If you got some guaranteed money, some other places to put money, the plan's going to work. But if you have no plan, how do you know? So again, time to get that plan. All you have to do is text the word visit to 800-454-1184. Again, text the word visit 800-454-1184 or click the link below.
Would you rather pay more or less in taxes? If you want to pay more, don't do anything. If you want to pay less, talk to Eric Heckman to see what's possible for you. 800-454-1184. That's 800-454-1184.
Hi there, I'm Luann Fulmer here with Eric Heckman. A recent global study found that fewer and fewer people are feeling optimistic about their retirement. In fact, just over 30% of the people are believing that they're going to live well or better in retirement as they did while working. So that's low, and that's a major drop in confidence. Eric, is this just a feeling, or should we consider this a new retirement reality?
Well, I mean, it is very different than, maybe not necessarily our parents, but at least our grandparents, right, who had pensions and stuff, and they were well taken care of, but they also had a shorter life expectancy. And so one of the weird side effects, I guess, of a longer life expectancy is the fact that you have to have more money, which means you might be more strained and worried and stressed, ironically, about having money because you're living longer, right? So is that a good longer living, or is that a bad one? And then of course the other thing is, I just the other day got my email from Social Security saying, hey, your Social Security statement's ready and stuff to go look at it. And so I always tell clients to look at it, make sure everything's accurate and stuff. So I went online and looked at that, and they did update it now to saying that they actually said it very creatively, which I thought was interesting. Not only did it go from 2035 when they're going to be not being able to pay all their bills, now it's 2034. And now they say we will only be able to pay $810 of benefits for every 1,000.
Oh my.
So instead of saying we won't be able to pay 19% of our bills, right? They say we'll be able to pay 810 of 1,000, right? Because if you do a percentage, it sounds worse. If you do a dollar amount, then you have to do a bunch of math and people don't think about it as fast. So obviously that's another big worry is if you are on Social Security and all of a sudden they cut your pay by 20%, what happens then? And, for a lot of people who aren't retired yet, that's, it could have been one of the major sources. And for people who are currently retired, the stats are somewhere around 50%, somewhere pretty close to that, where the only source of income for people in retirement is Social Security. So that would be very scary if all of a sudden they took a 20% pay cut.
Right. Yeah. Well, that makes me feel so sad. So, okay, the old rules are no longer applying. So how can people listening move from feeling anxious to feeling confident about financial independence and retirement?
Well, I mean, just think about if you're, you just got off the plane, you rented a car, and you're in some city you've never been to, and you have to go find your hotel. There's no GPS, your phone's not working. Nobody knows what a map is anymore. I mean, how confident would you be about getting to your destination, right? You'd be really stressed, and you might be able to find, like the downtown maybe of the place or something, but you have to go around asking people or something, right? It would be very stressful. So same thing with retirement. Once you have that written income plan and you've got it mapped out and you know how much money you can spend, you'll be okay. Then at least you know what the dangers are and you know where you're going to be headed. But without that GPS to kind of guide you, without having that blueprint to say, oh yeah, I'm going to be okay, then it's going to be very, very tough. And so, one of the things you have to do is just also not just have everything from one source of income, right? If it's just Social Security and then maybe just the market money that you have saved up, well, what happens if it's an '08 again? What happens if it's a .com crash? What happens if it's 2022 where the market's down 20%? What happens when those times come through, which they will, and then all of a sudden, you're out of money, or your money's dropping, not out of money, but right, you're not wanting to cash in stuff, but you have to because you need the money. So having that confidence and clarity really kind of stems from having a plan, having talk to somebody, having, worked with somebody who specializes in retirees, not somebody who also works with retirees, but works with 20-year-olds and 30-year-olds and, everywhere in between. You need somebody who's really focused on what is the math like in retirement and how much does that change?
Yeah. And that's what sets Heckman Financial apart from other financial firms, is that you do focus on retirement with retirees. Now, I do want to talk about diversifying income. Tell us what that looks like for someone who wants to protect, like you said, protect their essential expenses from inflation, market downturns.
Yeah. So you need to have some baseline, money that won't go away. Whether it's a bank, insurance company, or U.S. Treasury, those are only three places that can guarantee your funds. And we want to make sure that there's some money there. So that way, you have at least some certain dollar amount you can take out. Now, insurance companies even have ones that can pay for an income for life. Some of them now even have benefits where they'll double it if you need long-term care. So there's a lot of great products out there that can guarantee and protect your money. And you need a portion of that done. You need to have some baseline so not everything drops in those bad years. And then in the good years, you want stuff that still does pretty good and that's out earning, the lower interest rates. And so, there's a lot of great things ever since the rate hikes, came around and stuff, even though, rates have dropped back down. It's still really a great time to be looking at some of these options out there. But a lot of times people just don't know and don't ask. And, you don't know what you don't know until you find out, right? So, so that's one of the reasons why we built our toolbox. We have a Wealth Creator Toolbox. And what it is it's several really short, quick things to read and educate yourself about, am I paying too much tax in retirement? Will my money last as long as I do? Social Security timing decision, lots of great stuff in there. Even a digital version of my book, Worry Less Wealth, and a way to set a time to talk with us, Heckman Financial. So all you got to do is text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184, or you can click the link below.
Yeah. And remember, this is Wealth Creator Radio. So happy to have you along. I'm Lou Ann Fulmer here with Eric Heckman. Eric is a certified financial planner and someone who's devoted his life to helping retirees. So Eric, with so many people, like 70% of people feeling uncertain about their retirement, then how do you help your clients map out a plan to create that reliable income that they can count on for, decades, 35, 40 years?
Yeah, no, really, like I said, it comes down to that income plan. And so first and foremost, we see, okay, how much money are they spending? How much money they're going to really spend in retirement? Because you want to have that fund, do all those, fun adventures, do those cool things. And then, you want to make sure your healthcare is taken care of. The biggest cost for people in retirement is taxes. I mean, that's the part that people don't think about is, your taxes can be a huge factor. And so we want to make sure we have that accounted for. And then, we can actually have some of these guaranteed income accounts. We can have some of these protected accounts along with the stock market and other things. And then there's a lot of alternative assets too. There's things like private equity. There's things like real estate, other things that you should also have in your portfolio. So, if there was one product that did it all, well, I wouldn't be in business. We'd all just go put our money in it, right? But there isn't. And so that really the true answer is it's how you combine all these things. So it's kind of like, baking a cake or something, right? If you get all the right ingredients and you follow along and do the instructions, then it can work really well. But if you miss some, it's not going to be very great and such. So that's what we want to do. We want to make sure that you get it all dialed in and then you can have a great retirement and be confident and enjoy life. And, that's what we're all about. But, that's why it's worry less wealth. We don't want you to be worrying about your money. We want you to have going off and having fun.
Exactly. And like you said, baking is chemistry. And if you do something in the wrong order or whatever, it's not going to work out. And you do have to follow that, and I think that's great. That's what you guys do as far as a plan goes. And that study that we're talking about, showed that there is a lack of clear benchmarks that really undermines retirement optimism. So for anybody listening may be wondering, am I on the right track? I don't really know. What would be the first step you think they should take to get that clarity?
Well, first is just getting some education, finding out where they're at, finding out how much are they really spending, getting, like I call the no BS budget, where you look at your last 12 months withdrawals from bank account and total that up. And that's how much money you really spent. And then, adjust it for whatever, for fun, healthcare and stuff in retirement. And then once we have that number, we can kind of do the plan. And, that's where having that plan is critical. So again, if you want to get access to our digital toolbox and even set a time to get that plan for no cost, no obligation, all you got to do is text word toolbox to 800-454-1184. Again, text word toolbox, 800-454-1184, or click the link below online.
Do you know whether your retirement plan has any weak points? Discover ways on giving your financial future the proper tune-up. Simply go online to wealthcreatortoolbox.com to gain a better understanding in taxes, Social Security, and other ways to manage your portfolio. That's wealthcreatortoolbox.com.
Hi there. So happy to have you with us today. I'm Lou Ann Fulmer here with Eric Heckman. And today we've been talking about the growing anxiety that so many people are feeling about retirement. One of the most common fears people have, we always talk about this on our show, Eric, is the possibility of outliving their savings. So let's get into that. Tell us what is one of the biggest threats that could derail a nest egg at the beginning of retirement.
Yeah, well, one of the things that we do in a lot of our live events is often I'll show one slide where it's two brothers. One retires in 2000, the other one retires in 2010. And they each retired with $500,000. They each took out $30,000 out of that every year. So the first brother who retires, Bob, who retired in 2000, after that 10-year decade, he's down to $96,000 out of his 500. So he's got less than 4 years left of those withdrawals, right? And he's only 10 years into retirement. So he's freaking out. He's not he does not have worry less wealth. He's got worry full.
Right. Yeah.
And his brother Steve, after that same timeline, has over $800,000. He started with 500, took out 300 over those 10 years, and has still another 300 more than he started with. Now, lots of times people say, well, one guy was better at investing, the other, than the other. Well, the hard part of that about that is it was the same exact investment. It was the S&P 500. And nowadays you hear all these people just say, oh, just buy the S&P, buy the index, buy the index, buy the index. Well, people forget that there was a 10-year timeline where the S&P was negative. And also, if you were withdrawing money, you exacerbate that because when those things go down, you're taking out, it's kind of like a, snowball, you take out a little bit, but then it gets bigger and bigger because that money doesn't grow anymore. And so you're locking in those losses when you're on distribution mode versus accumulation mode. So, so that gets to be a really, really painful thing. And really when it comes down to is, I got my finance degree at Santa Clara and, university. And, it was this thing called luck. That was the technical term, right? They just, really, that's the only difference between the two is one got lucky, one didn't.
That's what I'm thinking.
And, I usually tell people, most people today should be retired for 3 decades. And if you look, there's, over a 3-decade period, almost always there's one bad decade, one okay decade, one great decade. And if you get that bad decade at the first, it's going to really filter through the whole thing. If you get the bad decade at the end, it's going to be almost meaningless because you had the good ones early on. So, that's one of the problems. So people need to have a different design to their portfolio to solve this.
Yeah, that's what scares me. Like you just said, it's the luck of the draw, what the market's going to do. So let's get into a little more, kind of share with us strategies that our listeners could, implement to try to protect their portfolio from this risk that we're talking about, especially in those critical early years.
Yeah. So it's all about having different types of buckets of money. So you want to, everybody always talks about the market money, right? That's the exciting part. They always talk to you about what they made money on. They always kind of forget to tell you the ones that they lost money on. And so that's, if you're looking at 401k, all you have is market money. It's stocks, bonds, but it's all in the market, right? So it all goes up and down with the tweet of the day or the news cycle of the day and all that stuff. And none of it's protected or guaranteed. So, what happens is when you have IRAs or other monies, you can do a lot better stuff with them. You can have stuff that's, more income focused that might still be in the market, but at least, paying more cash flow. You could have some guaranteed accounts where they can either pay an income for life or at least allow you to have a set withdrawal for 10 or 15 years. And so if you can take out so much money without locking in those losses, it's going to make that money last so much longer. And so that's one of the problems that people just don't realize is the spending is so much different in retirement, and they're using really the advice for people who are trying to build up money long term for 20 and 30 and 40-year-olds. They're not talking to people who specialize with working with people in their late 50s and 60s and 70s, taking the money back out, and very, very different math.
Yeah, very different math. Now, beyond market risk, let's talk about that. What other key areas should people be focusing on to try to ensure their money's going to last 30, 40 years in retirement?
Yeah, well, I mean, lots of times people use this 4% rule that was created back in the 90s, and when interest rates were really high and bonds paid a lot of money. And, it's still not bad. It's just, it's one of those things where, is that really the exact best way? I mean, it's a good rule of thumb, and all rule of thumbs are just that. There's some sort of general idea, so that means if you had $1 million, you could start off by taking out 40 grand. Well, that's not a ton of income. And now you might have Social Security, which hopefully we can depend on for a little while longer, but who knows?
Yeah.
And so, so that's why you want to be looking at not just how you're taking out the money, but are you lowering some of your taxes? Initially, when you first retire, you probably don't have a huge tax bill. So can you be, moving some of that money into Roth and be making it tax-free for the rest of your life? Because, you don't have to take money out till now 73 or 75. It used to be 70 and a half. So that gave us all a lot more time to actually do more of these Roth conversions, have more money tax-free. Because of course, if you can get rid of the taxes, that's, a 20, 30% pay raise, right?
Right.
So, if you can get rid of some of it, especially if you're in the 10 or 12% bracket, that's a huge, huge gain. So again, it's all about having a plan, all about having some knowledge, and that's what we do here at Heckman Financial. And so one of the things we did set up is that toolbox that has a lot of great information to read, a copy of my book, Worry Less Wealth, and also a way to set a time with us. So again, if you want to get access to all that, all you do is text the word toolbox, 800-454-1184. Again, text the word toolbox, 800-454-1184.
And thank you for joining us today. This is Wealth Creator Radio. I'm Luann Fulmer. We're here with Eric Heckman. And so obviously, it's clear making your money last requires more than just a good investment plan, like you're saying. You have to have a comprehensive retirement income strategy. And that's what you and your team work on. And you've developed plans that help retirees. It focuses on all the different retirement pieces. So for anyone listening right now who is worried about their own plan, what would you say is one of the most important actions they could take right now?
Well, you never know what you don't know, right? And so most modern cars have that little light in the side view mirror now, and it's the blind spot indicator, right? So if all of a sudden you're about to change lanes and it tells you, oops, hold it, don't do it. You're, you're about to have an accident if you do that. And, because blind spots, it's hard to see. That's why they call them blind spots, right? So, it's a great tool, it's a great safety feature. Well, what about your own retirement plan? What blind spots do you have there? You may have done a lot of stuff in your life more than once, but most of us have not retired more than once. So
most of us.
Yeah. So usually you want to get it right the first time, or else, it won't be as nice the second time probably, because, you had to go back to work, right?
Yeah.
So, so again, having that plan, looking at that, and that's one of the things we can do is we can sit down just to show people, here's what's working, here's what's not working. We do that for no fee or no cost, because I've just decided, hey, we want to be able to help people. We want to be able to get that information out to people. So we have that first meeting where we just talk about what your worries and concerns are. And then if it makes sense, we'll have a second meeting. Again, we won't charge you. We'll walk you through what income plan you have today, where you're headed, and, what's good and what's not good. And that way, ahead of time, and, you can make informed decisions before it's too late.
Yeah,
So,
I love that. And part of that, you do stress tests for people and their retirement accounts.
yeah. So not only just looking at the income, but on the investment side, how risky are you? I mean, especially when we've had several years of up markets, you may have only thought you were putting so much into risk areas, but now those risk areas grew so much bigger. Well, if all of a sudden those flip the other way, you may have had 40% of your money at risk, and now you have 60% of your money at risk, and you didn't even notice it because it kind of slowly happened over time. So, again, that's one of those things where we got to know that ahead of time and take action. So, again, if you want to get a little bit more information and talk to us, all you have to do is text the word visit to 800-454-1184. Again, text the word visit 800-454-1184 or click the link below.
Become a wealth creator today. Text visit to 800-454-1184 to schedule your 15-minute call with Eric and his team. That's visit to 800-454-1184.
Hi there. Thank you for joining us. I'm Luann Fulmer with Eric Heckman of Heckman Financial. Today, we're going to look at big tech, okay? It's changing rapidly. And as it turns out, the AI boom might actually be a bust for your 401k. So, Eric, for years, tech was seen as a guaranteed winner. Suddenly, though, things are shifting. So, Alphabet, okay, that's the parent company of Google, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla have lost an average of 11% so far this year. Okay, so it always fluctuates, but tell us what's going on.
Yeah, well, I mean, there's always pullbacks, right? First of all, these are stocks that are, once were, like maybe the top stocks might be 15, 20% of S&P. Now they've been almost running a third of the S&P for quite some time. So when you're talking about your 401k, or if you buy an S&P 500 fund, 1/3 of it almost is in these few companies. So when these companies have a bad day, your portfolio has a bad day.
Yeah.
And a lot of times you may not, really associate the two. But a lot of them have been spending tons and, billions and billions and billions on, all the promise of AI. And then, is it going to come out? Is it going to work in the end? Right. How do they monetize it? All these questions. So, you always have to watch out when these things pull back, but it doesn't mean necessarily freak out, but also just means you need to be diversified. You can't put it all, just in those big companies.
Yeah, like you said, Eric, a lot of people don't even realize how much tech is in their portfolio. Data shows that in some of the largest actively managed mutual funds used in 401k plans, technology and communication stocks make up 38% of the portfolio. So what happens to a retiree if this sector stays down?
Yeah, I mean, it could be really ugly because, one of the things people don't fully appreciate is the difference in the math and retirement. Because when you're working, all these ups, downs, sideways things, whatever you want to call them, right? They don't really matter too much long term because, you just hang in there and you're not using the money, right? So you're fine.
Yeah.
Then when you go to retire, you need to get that money out, not just once a year, but typically every month. You need some cash flow, right? You need to be able to pay your bills. You need to get that money. And if you sell it and the market's down, you're locking in those losses. So, it can be something that could stay down for a while. We've all seen stuff like, obviously the .com crash and '08 meltdown, all these different things. So yeah, if you're only having those types of portfolios, in your money, and those go down, those sectors go down, it could be ugly. So that's why you want some foundational money, you want some steady income money, you want some alternatives. This is the key part that people are missing usually when they go to retire.
Mm-hmm. So how important is it to change our mindset right now?
Well, you want to make sure that you have, not just everything that's all growth orientated. A lot of the companies you just mentioned there don't pay much in dividends. They pay very little. And so if there's no income, the only thing you're betting on is their stock price going up. And if they can't keep growing everything, guess what happens to your account, right? It goes down. So that's a little bit hazardous when you're needing to get cash flow. So again, it all goes back to having a plan. And if you look at that plan and you go, okay, well, I need to have so much in growth, so much in value, so much in stuff that pays income, steady income, some alternatives, some guaranteed stuff. Then I know how I can get my income. And then also once I have that personalized income plan, I can look at my risk score, look at my taxes I'm going to pay over time. And I know I'll be fine. But yeah, if you don't have that plan and you don't know that risk score and you don't know the taxes that you're going to be paying, over the rest of your lifetime, well, how do you make decisions? I don't know how people do it. So the only way I know how to do it is, look at that plan and say, okay, this is the right way to go, or this is the wrong way to go. You don't need to have anybody's opinion, because once you have a model, you can look at it, go, oh, this is exactly how this will work. And I know I'll be okay. So,
Right.
Again, that's what we've set up. But, if you just want to at least get the beginning parts, you can go for our digital toolbox. And that has stuff like, am I paying too much in taxes in retirement? Will my money last as long as I do? A copy of my book, Worry Less Wealth, and a way to set a time with Team Heckman here. So all you got to do to get access to that is text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184, or click the link below.
And we're so glad to have you with us today. This is Wealth Creator Radio with Eric Heckman. If you are just joining us, I'm talking with Eric about how AI is bringing sweeping changes to the tech sector and how this shift in the market could permanently impact your retirement savings. We don't want that for you. So, Eric, I want to get your reaction to this. Bill Bengen, he was the creator of the 4% rule, okay? And he shared that he recently adjusted his own allocation, reducing equity exposure and shifting away from certain sectors, including technology. What should we make of this?
Well, he's not necessarily perfect, right?
True. Yeah.
So just because he's, got the claim to fame of calling that rule, the more important part is what's he been doing with interest rates over all those years and things like that. Because that rule was built when bonds were paying 6-7%, not, they're almost back up to there now, but then they keep dropping back down and up and down. And obviously they were down below that a lot more. There is no one rule that works. It's really more looking at the whole asset allocation, look at your risk level. Do you have some guaranteed assets that prevent you from even taking that? Because one big problem with his rule is it says 100% of your money should be in the market. Well, who wants that? All right. If you have 100% of all your money at risk and you're living on that money for the rest of your life, that's pretty dang scary.
Right.
I don't know if you'd want to be able to try to sleep at night and knowing that all your money could drop at any time.
Mm-hmm.
Bonds go down too, right? So it's not just bonds versus stocks. So, so that's one of the biggest issues is really, making sure that people know how to take this money out, know how it's going to work, and making sure it's going to last. And then that way you can live your life and go off and have fun, do those trips you want to do, spend that money while you're alive and you can still do it. Spend the money with your family and time and having experiences, right? Yeah, that's what it's really all about. And, unfortunately, too many people get hung up on these little details. And, really what we need to do is have the plan and then figure out, okay, let's make sure this plan's going to work, and keep on working. And, hopefully it does, right? But, but at least as long as you got a plan, you're going to be a lot safer off.
Right. And having that plan and someone like you guys at Heckman Financial to kind of be, someone to lean on, just to help out when we feel a little bit nervous. Eric, when we look at trends like this, sequence of returns risk, you've talked about this before, can come into play. So can you explain that again?
Yeah, well, one of the ones we use in our live events is like two brothers, a story of two brothers. And Steve, retired in 2000, had $500,000 and took $30,000 out for 10 years. At the end of 10 years, he's got $90,000 left. He is almost out of money. So he's very worried, right? Because he's only 10 years into retirement, not that old. His brother retired in 2010. He took the same $30,000 out of $500,000, and he's got almost $900,000 left. Now, the crazy part is people go, what's the difference? Well, it's S&P 500. They both were the same thing, but people forget for 10 years straight, the S&P actually returned a negative 1%. But it's been too long now since we forgot about that. So, again, that's where having a plan, knowing your risk level, knowing what's out there, so that's why we set up that digital toolbox. So if you want to get access to it, all you got to do is text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184, or click the link below.
Imagine for a moment that an intense storm is pounding your house. Will the roof leak? Will the siding peel away? Will your basement flood? If your house is properly built and maintained, you'll be fine. But what about your 401k or your investments? The stock market has had a great run the last few years, but is its current turmoil making you feel uneasy? Are you confident your portfolio is built to weather the financial storm? Now may be a great time to have your retirement plan inspected. Call Eric Heckman of Heckman Financial at 800-454-1184 now. Eric will examine your portfolio and show you if your investments are in need of some weatherproofing. Call Eric Heckman of Heckman Financial today at 800-454-1184. That's 800-454-1184. Investment advisory services offered through Heckman Financial Insurance Services, Inc., a registered investment advisor.
Hi, thanks for joining us today. So happy to have you along. I'm Luann Fulmer here with Eric Heckman. So right now we're going to have Eric give us an example of someone who has experienced one of those retirement obstacles. We call this our financial fail, and this is because we want to learn from, what people have done or experienced and to try to avoid that and not do it. So Eric, tell us about what you have for us.
Yeah, well, this is a client, Don and Anna, and he had been having health issues for quite some time, and he was actually out on Social Security disability. He was able to qualify for that, which usually you have to be fairly ill and have issues and stuff. And especially with COVID, he just could not work. And so that was fine. But then she started getting jealous, right? Oh. He's home all the time. I'm working. And so she wanted to, retire. And we've run the numbers a few times, but what we ran originally, what they were going to be spending, and now what they're withdrawing is massively different. Now all of a sudden it's like, oh, well, we wanted to do some improvements on the house too, and we wanted to do this, and well, most of their money's in taxable accounts, so it's not just you don't just take out $20,000 to get $20,000. You have to take out 26 to net 20,000, right? And we just recently met, and when I was looking at their tax statements and looking at how much they fully withdrew, she likes to run her own money, and I just help him with his. And, but we do the planning together, and we updated her values and such. And I mean, they're still doing kind of okay, but I mean, they do have a lot saved up. They've got about $1.5 million saved up, so that part's great. But they took out about $120,000 last year. So, or actually, I think it was a little bit more than that, which, they were getting up to almost a 10% withdrawal rate. And this is when they're in their 60s. So it's one thing to have that big a withdrawal rate when you're in your 70s or 80s, but that early on, that eats up all that money that can't now grow over time, right? Can't compound. It can't keep getting bigger. So it's one of these things where he keeps going, yeah, I really think she should go back to work or go look for a job. Just because, they are worried about it, about how long is everything going to last. And right now, they definitely have another 15 years, but you don't want to be 78 and all of a sudden find out you should be going back to work, right? So
no way.
That's a little tough at that age, and to be doing. So, the nice part is, at least with the income plan, we can be looking at this, we can be seeing this, we can be monitoring it in real time and going, okay, well, you kind of need to stop doing some of these improvements or stop doing some of those fun stuff you're doing or whatever, right? and kind of mellow down the spending. But that's the hard part is people think the money's going to last forever. And then all of a sudden it's like, whoa, you have a whole bunch and then you start spending too fast. So again, that's why you have to have that income plan. Thank you for tuning in to Wealth Creator Radio. I'm Eric Heckman, and it's been a pleasure guiding you towards a more confident and secure retirement. Remember, my responsibility is to always do what's right for you, our client. Together, we can cut out that fancy-sounding financial jargon that doesn't help and focus on what truly matters for your financial future. If you're ready to take control of your retirement planning and build a personalized income plan, contact us at 800-454-1184 and text the word TOOLBOX to schedule a complimentary consultation. If you're looking for more resources and tools to build your retirement future, don't forget to check out that Wealth Creator Toolbox, your toolkit for a secure and confident retirement journey. Until next time, retire more and worry less with Wealth Creator Radio.
Information provided during Wealth Creator Radio is for illustrative purposes only and does not constitute investment, tax, or legal advice. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal, or tax professional before taking any action. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Individuals should thoroughly review the contract for specific details of the product features and costs. Income payments and withdrawals from deferred annuities are generally taxable as ordinary income in the year they are taken. Eric Heckman offers investment advisory services through Heckman Financial and Insurance Services, Inc., a registered investment advisor. Any tax advice given as part of this presentation is not intended to be used and cannot be used by the taxpayer for the purpose of avoiding tax penalties or promoting, marketing, or recommending to another party any matter or transaction addressed herein. The views and opinions expressed in the program are not necessarily those of the radio station or its sponsors, and they should not construe as legal, tax, or investment advice. You should always consult the appropriate advisor before making any financial decision.